Have you ever imagined earning money without doing anything? Think about this. You're watching TV the whole day, and when you check your bank account, your money has increased. Sounds too good to be true, right? Well, in investing, this is a normal scenario, especially through dividends. So in today's video, I will share to you why I love dividend investing and also my progress in using this strategy. With that, let's start. Now let me just remind you guys, this is not financial advice. This video is for educational and entertainment purposes only. Now since this video is about all the things I love about dividend investing, I would also like to share with you a video I made about the things that you should avoid doing using this strategy, and also book summary video about dividends, which is the little book of big dividends. If you want to watch it after this, I have a link down below. Now if you buy a stock of a company, you are entitled to a portion of their earnings, which is given through dividends, at which some companies pay out once, twice, and some even per quarter. This is given in cash and sometimes in the form of stock dividends. In my experience, this is one of the best things about investing in stocks. Like what I shared with you a while ago, even without doing anything, just by holding a stock of that company, you are given cash directly into your brokerage account. I sometimes don't know that the company would be paying out dividends. I just notice it when I open my brokerage account and find my money had increased. How fun is that, right? Though dividends are only a small percentage, if reinvested over and over again, this will compound and take up a majority of your total returns. Like the saying goes, small things compounded over time make a big difference. There's a study to back this up. This is a study by Hartford Funds showing the difference between dividends reinvested versus not investing it. This is a $10,000 investment from 1960 to 2021. For the total return with dividends, your $10,000 would compound to a staggering $4.9 million. But if you didn't reinvest dividends, that $4.9 million would only be $795,000. That big of a difference. This isn't just seen in the S&P 500. Another study by Schroders expanded this to the different indices like Hong Kong, MSCI World, FTSE, which is in the UK, and a lot more. This is from 1993 to 2018. With that, if you take away dividends, if you are investing in Hong Kong, your 10.7% annual return would only be 7%, and the difference is even greater in the UK index, at which your returns would almost be halved. With these studies, we can see dividends play a big role in the overall returns of the market and should not be taken for granted. Now, the best things about holding dividend-paying stocks is you don't need to sell to earn money, because there are two ways to earn in stocks, right? It's through capital gains and dividends. So for you to get your capital gains, you need to sell assuming that stock has already risen in value. But for dividend stocks, no matter what state the stock is in, your dividends won't change. The best example of this is during the peak of the pandemic. Some companies' stock price went down so low, but they still paid dividends. And the best thing about a stock going down in price is when you buy them, their yield also gets higher. Now let's put LTG stock as an example. They paid a total of 1.08 pesos of dividends in 2020. If you bought their stock in 2018, let's say around an average of 15 pesos per share, your dividend yield would amount to 7.2%. But if you bought during the peak of the crash in 2020, around 7.5 pesos per share, that yield would go up to 14.4%. Imagine, just by holding the company, you get 14% return just through dividend alone. This is even when their stock price was cut by more than half. Now this leads us to another point why I love dividend investing. You get peace of mind. Why? Well, the stock price was cut in half. Most investors would panic during that time and sell that stock. But if you know the company you are holding and you know that they have strong financials, manageable debt, you know the decreasing stock price isn't something to be worried about. And the best part of it, you are still earning money while waiting for the stock price to increase. And you can even buy more of the company to increase your dividend yield, since you plan to hold them for a long time to get dividends per year, thus creating cash flow for you, which gives you a peace of mind. Peace of mind is important in investing because a lot of investors lose money because they are in a state of panic. They make irrational decisions like selling great companies at a loss, then end up disappointed once more after the company's price recovered in a short time. This creates another chain reaction at which you buy again at a higher price. The cycle goes on and on. Unlike when you were receiving dividends while waiting for the stock price to recover, you not only earned money while waiting, you also prevented selling at the worst possible time. And not only that, you get to have a chance to earn more again when the stock price recovers and eventually rise to more than what you paid for it. To show you one example of this is my portfolio. Now, I've only been investing for over 2 years, and I happen to be one of the lucky ones that started investing just right before the market crash of 2020. Imagine, I've only been investing for a year and I experienced a crash that sent my stocks tumbling down by more than 35%. How exciting is that, right? But again, I didn't panic since I know the companies I hold are strong. I just invested every month like I normally do. So as behold, even though my stocks plummeted down, they are still giving me dividends. From my first year of only getting 161 pesos, climbing to 8,700, and in 2021, I had 43,000 pesos. This made me love more dividend-paying stocks since even though I'm in a negative, I still had that sense of security that I am still earning money while waiting for the market to stabilize and recover. And I know in myself that I am willing to hold the stock I own for a very long time. So short-term price fluctuations are not a big deal for me, and I am even happy that I get to buy them at a cheaper price, thus having a higher dividend yield. Now I show an update of my portfolio every end of the month, so if you want to see that, just go to my channel page and I have a playlist there showing my progress, showing those painful days where my portfolio is in a negative. Imagine how painful that is for a finance channel to show your portfolio is in a negative. My pride, my goodness. Anyway, this in turn leads us to my next point on why I love dividend investing. You get to go for the long run. Well, I think I don't need to explain much about this because of all the things I said. With peace of mind at your side, investing for you is so easy. And when things are easy, the more you get to stick with the strategy. Because we know for a fact investing in a longer time horizon in the stock market is the way to go to accumulate huge returns. Just look at our index. It crashed a lot of times in the span of 40 years. But if you just held on, invested diligently every month, those market crash doesn't mean a thing for you. Because even with all that, in the long run, you remove all the risks involved in stocks. Your returns are the sure positive if you just invested consistently and with the mindset of gaining more dividends when you invest during a market crash when stocks are cheaper, the more you will have a better mindset about investing that will let you stick with it in the long run. Not just that, with the continuous cash flow given by dividends, if you reinvest it, you remove the possibility of missing out on the best days of the market. You get to buy during the dips because of the dividend reinvestment strategy. Now, this is a study done by Forrester's Financial, showing if you miss certain days of the market. If you miss out on the 25 best days of the market, your supposed to be 9.82% returns would be cut down to just 3.92%. With a constant flow of dividends in your portfolio and a proper mindset, you are not just in the market during these times, you are also investing because it has already been proven by countless of research that time in the market is more important than timing the market, and dividends play a big role in that. With you standing on the sidelines, your cash doesn't earn anything. Meanwhile, if it is invested, you are earning dividends in the process, and those dividends you earn will again earn more dividends for you when you reinvest it. This compounds in comparison to you just standing on the sidelines, letting inflation eat away your money, waiting for a market crash to happen. Now don't get me wrong, it's good to have some money on the sidelines if the stock market is relatively priced high and you can't find any good companies out there to invest in. But don't just go full cash and pray for the market to fall because no one knows when that will happen. No one can predict the market, so it's good to have a certain amount always invested in the market. This removes the possibility of missing out when the stock market goes up even higher. This also removes that intention to buy when the market is going up. Imagine, a lot of investors do this. They go full cash, then when they see the market isn't going down, and instead went sky high, they feel they will be missing out on profits. They couldn't wait anymore and invest at the peak of the market. Then eventually what they waited for came, leaving them with a huge negative because they invested with no margin of safety. Again, this is the best effect of getting cash flow from dividends and reinvesting it. You remove these feelings and you get to even cost average your way in different market situations, may it be a bull or a bear market. But a reminder, like every strategy, dividend investing isn't perfect. There's no such thing as a perfect strategy. There are things you need to avoid doing when you are using this. Now, I won't discuss those things in this video since I've already made a video discussing that. I really suggest you watch it in my book summary of the Little Book of Big Dividends. It also adds emphasis to everything that we've talked about. With that, this ends this video for today. I hope you liked it, and before you leave, be sure to hit the like button first. If you still aren't subscribed yet, do subscribe now. You won't regret it, really. So thank you and see you in the next video.